All right, let's dive into the second quarter 2025 earnings for Parfums. Ticker IPAIR. Now, at first glance, the numbers were, well, they were kind of all over the place. But once you dig in, you start to see a really clear strategy emerge. So, let's break it all down. Okay, right out of the gate, the big headline grabber was the earnings miss. Parfums came in with a GAAP EPS of 99 cents. Now, the Wall Street consensus was looking for $1.08, so that's an 8% miss. And right away, that puts a big question mark on the quarter and kind of explains the market's initial reaction.
So what about revenue? Well, the top line landed at about $334 million, which was pretty much exactly what analysts expected. But, and this is the key detail, that's still down 2% from the same time last year. So even though they hit the target, the growth trend itself is slowing down, which just adds another wrinkle to the whole story.
But this is where things get really interesting and, frankly, impressive. Even with that revenue dip, look at this. Their gross margin expanded by 170 basis points. That's a full 1.7 percentage points, hitting 66.2%. This is a huge signal that their pricing power and their shift towards more premium brands is absolutely working. And you can see that same kind of discipline when you look at their cash flow. We're talking about a massive turnaround in the first half of the year. They went from burning through $26 million last year to actually generating $5 million this year. That is a $31 million positive swing. Just incredible management of their working capital. So let's put all the pieces on the board. You've got revenue down a little, but fantastic gross margins. So why did their overall operating margin actually dip by 120 basis points? Where'd the profit go? Well, it was a choice. They deliberately cranked up their advertising and promotion spend. They're investing in their brands right through this soft patch. It's a classic playbook move. Spend money today to make even more tomorrow.
So what's management's take on all this push and pull? To really get it, we need to zoom out and look at their strategy, especially now that the crazy, explosive growth we've seen in the fragrance market is finally starting to cool down a bit. And you got to give them credit. They were super upfront about this. The CEO, Jean Madar, he came right out and said that global fragrance growth is easing up and that they expect these headwinds to stick around for the rest of the year. That kind of honesty really provides the context you need to understand their revenue numbers and their proactive moves. And here are those moves in action. See, they're not just sitting back and waiting for the storm to pass. They are making some big plays. They locked down the exclusive license for the luxury brand Longchamp, which is huge, by the way, with no upfront fee. They're also launching their first ever owned brand, So Ferrino, complete with a flagship store in Paris. And they're getting smart about e-commerce, rolling out special programs for TikTok Shop. They're adapting. Okay, so let's talk about those headwinds. What are they exactly? Well, the call really focused on two major challenges, tariffs and something called retail destocking. Let's look at what they are and how the company's fighting back. First up, this key term, destocking. It sounds complicated, but it's pretty simple. Think of it like this. Your local department store is getting a little nervous about the economy, so they're ordering less perfume to keep in the back room. Now, management was clear that you, the end consumer, are still buying plenty, but their retail partners are being cautious, and that creates a temporary drag on Parfums' sales numbers. Now for some actual good news on the macro front. The whole tariff situation ended up being way better than anyone expected. Seriously, everyone was holding their breath for tariffs on European goods to be somewhere between 30 and 50%. The final number? Just 15%. It's still a cost increase for sure, but dodging that worst-case scenario was a huge relief. So they're not just taking this on the chin. They have a really clear two-pronged attack plan. First, they're raising prices strategically, about 2% on average across the globe, but a bit more aggressively here in the US to offset those tariffs. And second, they're getting smarter about their supply chain, moving some sourcing away from China and producing more locally to keep costs down. Okay, so we've unpacked the numbers, we've heard the strategy. So what's the bottom line here? Let's distill all this down into a rating and a potential trade idea based on everything we heard. And this is the big question for anyone looking at this stock, right? Management is so confident that they reaffirmed their full-year guidance for both sales and profit. And yet, the stock has been lagging. That gap tells you investors are in prove-it mode. They need to see that second-half pickup that management is promising. Because of that dynamic, our rating here is market perform. Look, the company is executing beautifully from an operational standpoint. The margins are great, the long-term brand strategy is smart. But these short-term market headwinds are very real. The stock feels like it's priced about right until we get that concrete proof that the second half of the year is going to be as strong as they say it will be. And just a quick and very important reminder before we go any further. This is not financial advice. This analysis is for informational and educational purposes only.
All right, with that said, here's an idea. If you're a believer, if you think management strategy is going to pay off big time once we get past this current choppiness, you could look at a long-dated call spread. It's basically an option strategy that lets you make a defined risk bet that the stock will rise. By buying a January 2027 call at $120 strike and selling one at $140, you create a low-cost structure to play for that comeback story in 2026. So we'll leave you with this final thought. Management is standing firm, reaffirming their guidance while the market seems skeptical. So is their confidence a real buying signal, or is it a bull trap in a really tough environment? The numbers next quarter are going to tell us a whole lot. That's all for this earnings breakdown.